Hello to all investors, thank you so much for tuning in. In today's video we'll do 5 takeaway lessons from One Up on Wall Street by Peter Lynch. Please stay till the end for the bonus lesson. Look where Wall Street is not looking is our bonus lesson. With all due respect and no further delay, let us dive in. Lesson 1. Objective and clarity before jumping in. Did you know that 3% of brain power can pick stock better than average Wall Street stock pickers? But before we jump into the market, we should ask ourselves the following questions. 1. How much do we trust corporate America? 2. Do we even need to invest in stock? 3. What do we expect to get from them instead of a losing lottery ticket? 4. Are we in it short term or long term? 5. How will we react to a price drop? Did you know from loss aversion bias we tend to feel double the pain of losing than winning? It will take us 2 winnings to recover from the emotional pain of 1 loss. This is why some investors double down on their losing stock hoping it will come back up. Most of the time this strategy will fail. Therefore, knowing how you react to a price drop before it happens is very crucial to stabilize your emotion when it does happen. 6. Do you believe that stocks are riskier than bonds? The first lesson here is by asking all these questions in advance, so we can declare our objective and clarify our position before we jump into the market. Without knowing the objective and clarification, we will be a victim of the market by being indecisive with a lack of conviction. Many investors perish because of this. Remember, the stock market demands conviction and victimize the one that is not. Lesson number 2. Stock doesn't owe us anything, and 3 key elements to be in this game. Nowhere is written that stock owe you anything, and even holding blue chip stocks are risky too. Gambling or investing is all based on the dedicated skill of the particular participant. A stock picker who rushes in and out of the market is not a reliable person to be in there in the first place. This is the same notion as picking the prettiest horse on the racetrack. People who do well in the stock market accept periodically losses and unexpected events like the black swan. Do you know the reason why the stock market is worth entering? Besides making money while you're sleeping? Well, if you invest $1,000, and if you are wrong you can only lose $1,000, but when you are right you can have a huge upscale. This is clearly the reason why the stock market is worth entering, but only if you know how to play this game. And the 3 key elements to be in this game are: 1. Patient. Patience is not passive, on the contrary, it is concentrated strength. Bruce Lee. 2. Discipline. Self-discipline is the #1 delineating factor between the rich, the middle class, and the poor. Robert T. Kiyosaki. 3. Learning. Continuous learning is the minimum requirement for success in any field. Brian Tracy. In any game we play, it requires works. Are you up for the challenge? If so, please continue to lesson number 3.
Before we move on to lesson number 3, please, if you like what you are seeing so far, may you kindly click that like button below and kindly subscribe to our channel. This will really help us a lot, and we truly owe it all to you. Thank you.
Lesson number 3. Do your homework and can you pass the 11 mirror test? As mentioned in lesson number 2, when buying blue chip stocks it can still go down as long as 5 years. Therefore, we should ask ourselves, do we need this money in 5 to 10 years before we throw it in the market? Review our budget is a very important first step. And for anyone that owns a house, close your eyes. Can you remember the time before you bought that house? It didn't take you 1 minute to buy it, did it? Even finding and calling your agent takes longer than that. So why are we buying stocks in such a hurry and selling it without delay? As Mr. Lynch mentioned, people spend more time and effort to buy the right refrigerator than they do to buy the right funds. 11 mirror questions to find out if you can be successful in the stock market. 1. Do you have patience? 2. Self-reliance. 3. Common sense. 4. Open-mindedness. 5. Detachment. Can you separate yourself from your stock in the stock market? 6. Persistence. 7. Humility. 8. Flexibility. 9. Willingness to do independent research. 10. Willingness to admit mistakes. 11. The character to ignore general panic. What is your score out of those 11? If you don't mind sharing it with us in the comment below. Lesson number 4. 6 things to remember when picking your own stocks. 1. Look for opportunities at the place where Wall Street did not verify. 2. Invest in a house before you invest in a stock. 3. Invest in the company, not in the market. 4. Ignore short-term fluctuation. 5. Both large gains and losses can be made in common stocks. 6. Predicting the market is futile. Did you know the average person can come across 2 or 3 prospects of a 10-bagger a year? For those that don't know what a 10-bagger, Mr. Peter Lynch coined this term for stocks that give him a return 10 times the capital that he invested. So if he invests $1 and gets back $10, that is a 10-bagger. We have to understand the company in and out, and the best place to find it is through research or talk to reliable people in the industry. If we wait to hear it from Wall Street or the news, it is probably way too late. In order to find a 10-bagger, we have to look in the land of fast growers, and that lesson is next. Just a quick reminder from payingforward.net: please, if you do well, or when you do well in life, seek ways to pay it forward to others that are less fortunate than us. Direct giving is what they believe in. Thank you. Lesson number 5. Developing a story and place it in the 6 categories. Developing a story of a particular company we want to invest in only takes a few hours, but this is the cornerstone of successful investment. First, we have to relate the size of the company with the relation to its industry. Then place it in these 6 categories. 1. Is it a slow grower? Usually, mature companies tend to have slower growth. 2. Is it stalwart? Loyal, reliable, and hardworking company. This company is growing faster than a slow grower, and the expectation of earnings to grow about 10 to 12% a year. Take Coca-Cola to be this example. Stalwart companies tend to have a moat of protection during recessions, but that is not always the case. 3. Fast grower. This tends to be a small and aggressive enterprise. 4. Cyclical. These types of companies often produce high-ticket items. Knowing these companies' sales can be helpful in indicating how the economy is doing. People only tend to buy high-ticket items when the economy is doing well, and vice versa when the economy is doing badly. In a bearish market, steer away from cyclical companies. 5. Assets plays. This tends to be companies like utility companies where assets are the driving force of their earnings. 6. Turnarounds or financial disaster company, but can make a rebound like Chrysler. The key is to get in before the rebound. As mentioned in lesson number 4, faster growers are the land of 10-baggers, but we must look for a good balance sheet with fast grower companies, and the main key is the company has to make profits in order for us to consider it. The next step is to fill in the details so we can tell how the story will play out. If you are wondering what are details that we should fill in, please check our video in the bonus section of Learning to Earn by Peter Lynch for the details. We will leave the video on the end screen. Thank you for making it this far. For anyone that is interested in free calculators to calculate the intrinsic value of stocks, please visit our website at www.valuesnip.com. Thank you. As promised, here is the bonus lesson. Look where Wall Street is not looking. There are 13 points here to cover, but for this quick summary, we are going to just cover 6 of the 13 points that we felt to be the most important. 1. The name of the company is usually dull or ridiculous that attracts no one to talk about it. 2. The company that is doing something that is very boring. For example, garbage collector companies or companies that produce bottle caps. I don't know what is more boring than those two, but if you have boring companies in mind, please share them in the comments below. 3. A company that does something disagreeable that turns people away. Is ideal, but make sure it is not morally wrong. 4. Spin-off companies are companies that can survive on their own. Large companies do not want their spun-off company to fail, it will create bad publicity. However, it is worth noting from our lesson in the essay of Warren Buffett's spun-off company are usually still trapped in their parent bureaucracy, but at the expense of the owners. So be careful with a spun-off company. 5. The institution doesn't own it and analysis doesn't follow it. This is a good sign that we are on a right track. Good investors usually go against the herds. 6. Depressing something about the stocks. For example, funeral home companies or funeral-related services. It is part of life that we all must eventually pass, but even death costs money. The business to carry us on to our ultimate faith can be a good business to invest in because it is depressing in Wall Street, or the media might not be interested to cover it. Have most of the points connected together is usually a great starting point to look in a stock. The objective is to get there before Wall Street gets in, and when they do come, the stock price will often rise. Thank you so much for your time and your attention. We greatly